Hi, welcome to the Clear Financial Thinking Monthly Market Risk Report. Today we have some new data in that we fed into our Market Vulnerability Index, and it is helping us to make decisions and understand the current risk in the stock market. First, a quick recap. What we did and how we got here is I tried to answer some important questions like why are the stock market valuations so high right now and why have they stayed high for so long. So that was videos 1 through 4. Then we looked at what pillars are propping up the market and what can take those down. Those videos 5 through 7. And then we looked at how can we measure market vulnerability, and that's when we came up with this Market Vulnerability Index. And then finally we applied that index across historical timeframes to validate that it was useful, and then show how it could be used. So that was video 9. So today what we're doing is we're updating, and we're going to do an update every month based on things that have changed. But first, what the index is, there's 8 different components that go into the index. And it pulls data from a variety of sources. And you can see we've listed the sources here in this center column. And it's all available on the web. It's a lot of government sources. And then there's 37 different things that we're pulling from these sources and measuring, and we've weighted them based on how much we think each of them influence the vulnerability of the stock market, and we come up with this score. So here's let's just walk through each one real fast. So number 1, valuation, that's heavily weighted. That's like how expensive things are. We're looking at the Shiller CAPE ratio. We're looking at the Buffett indicator. Inflation is huge. We look at CPI, PCE, labor market, interest rates, liquidity. These top are really 4 of the big drivers for our index. As we go down the list, the influence on the index is a little bit lower, but still important. We look at market sentiment, margin debt speculation, economic momentum, and consumer strength. And then we crunch that all together and we produce a score. The reason I'm calling it an index is that it's following a documented methodology. If you'd like to see that documented methodology, leave a comment, leave a way for me to contact you, and I'll send it to you. But it uses the same calculations every month. We could apply those calculations to history, so we can see how it would have predicted things in the past. And it's all data that's available publicly. So if you want to look at the source data, you could do that as well. But what it's produced, so when we use that model and we apply it to data historically, we can see that it did a pretty good job of predicting vulnerability around .com peak, as well as the post-COVID peak when there was so much stimulus going on. And sure enough, there were corrections that occurred after those 2 periods. And now we're heading back into that zone where we're saying the higher the number is the higher the risk or vulnerability. Anything over 80 is an extreme. And we just got over 80 this month. So last month it was 78.6. It's climbed to 80.3. Here's the factors that influence the change. Valuations remain high, margin debt, record levels, sentiment also increased in risk. And then inflation is still steady. It went up a little bit, as you saw in the last inflation report. We're going to keep a close eye on that. But then there were some positives as well that brought the vulnerability down. The labor market is still resilient. Consumer spending is holding up. So overall, it did climb into the extreme risk because it went over 80. Today, there was a jobs report, and it didn't change the index too much. It was about 0.2 change. That's because non-farm payroll did go down. It was expected to be 115. It was lower. It was negative, but the stock market, or the Dow anyway, took that as positive because they saw it as less likely that the Fed would increase interest rates. But this is something we're going to have to look at month over month to see trends. If it continues, if we continue to get, poor jobs numbers, then, that's, of course, will more negatively impact our index. But it's also interesting. We're seeing prior month adjustment revisions. It'd be interesting to see if that continues as well. But you can see the average hourly earnings year over year is remaining fairly stable. So anyway, there wasn't a huge impact to the index based on the jobs report today. So what is the key takeaway? So the key takeaway is that our MVI follows historical patterns. And if I should say it follows historical patterns, that there will be a correction coming in the next 11 to 14 months. That's about how long we saw the value stay over 80 on the .com and then the post-COVID peaks. So if we're consistent with that, we're going to see a correction soon. The most likely trigger is rising inflation, which would then follow with an interest rate increase. And then we'd also be keeping an eye on consumer spending, because that would likely impact consumer spending. And then the other thing that, unrelated to that chain, but could happen, could be another trigger, is if we see missed revenue. Of course, in all of the S&P companies, but with a special focus on the AI companies, because of how much speculation and investments are going that direction. If we don't start to see the revenue follow, then I think there will be a pullback there. So those are the things we're keeping an eye on. Thank you for watching. We're going to, as I said, we're going to post updates to this index every month. And our next video, though, before that, is we're going to dive into the upcoming data reports around inflation and what we think that may be and what that may precipitate, since that's the first domino in the chain that we were just describing. So if you enjoyed this, please subscribe, and have a great 4th of July weekend.